Good afternoon, and welcome to Lease Accounting Ramifications of the Evolving Real Estate Climate, presented by CoStar Real Estate Manager. Thank you for joining us today. Before we get started, we would like to share some information regarding CPE credits with you, and we appreciate your patience. Today's webinar is worth one continuing professional education credit. To be eligible for CPE credit, you must have a total viewing time of at least 50 minutes and respond to at least 3 attendance checks throughout the webinar. These will appear as a pop-up window on your screen along with an audio cue. Participants will have the opportunity to download their CPE certificate immediately following the webinar if the requirements are met. In accordance with the standards for the National Registry of CPE sponsors, CPE credit will be granted based on a 50-minute hour. We are unable to grant CPE credit in cases where technical difficulties disqualify eligibility. CPE program sponsorship guidelines prohibit us from issuing credit to those not verified by the technology that have satisfied the minimum requirements listed above. You can find a copy of today's slides in the Resources tab on your screen. After the presentation, this webinar will be available on the FEI members site where you can replay and download. After the conclusion of the webinar, your CPE certificate will be available in the certification window and will also be emailed within 24 hours should you meet the criteria. Below the speaker biography window is the Q&A box. Please feel free to ask questions throughout the presentation, and the speakers will answer as many questions as possible. Now, it is FEI's pleasure to introduce today's speakers, Matt Waters and Tim Culber. Matt?
All right, thank you, Boyana, and welcome everybody. I'm glad you all joined us today. And as Boyana mentioned, we're talking about the ramifications for lease accounting from today's evolving real estate environment. And again, my name is Matt Waters, and I'm a CPA. I've been with CoStar Real Estate Manager now for about 8 years, and we have a lease accounting, lease administration software. And at this point, we've helped over 1,000 companies go live with ASC 842 and IFRS 16 accounting standards. Of course, there's a big push for that around 2019, and it's just continued since then. Now we're squarely, from the software standpoint, we're squarely in a market where we are helping our customers upgrade lease accounting solutions. But what has happened over time is basically we, as an accounting software provider, we don't provide accounting advice, right? We provide software for companies to do their own accounting, but we do get a lot of accounting questions. How do I do this in your software? And how do, what if we have an abandonment, or what if we have a termination or an impairment or things like that? And I probably sound like a broken record to our customers at CoStar Real Estate Manager, because I say, well, what's your accounting policy on that? And then I'll try to help you understand how to accomplish that in CoStar. And if they still have questions, I ask them to get advice from their accounting advisors or their auditors. And so as those questions have developed over time, we keep up with them. And sometimes I refer people to Tim Culber, who's on the call with us today. Sometimes I ask Tim questions myself. But today I thought what we could do would be just kind of simulate some of those discussions live with our audience here, and just ask Tim to go through some of the most common questions around the changing or evolving real estate environment, and hopefully you'll walk away with a better understanding of when you have a termination scenario, if that's a lease modification, or if it's an impairment, or if you're indeed in an abandonment kind of scenario, and many other, I'd say many other decisions that can occur along the way. So that's what we're doing today. And again, I'm really happy that you joined us. I realize I skipped a little bit of my background. I've worked in lease accounting for about 20 years now. Before CoStar Real Estate Manager, I worked at Home Depot and led the lease accounting team there for about 6 years. Also worked at American Tower, which is the largest telecommunications REIT, and we had hundreds of thousands of leases there. We did the accounting for. So thanks again for joining us today. And now I'll turn it over to Tim. Tim, thank you for being here today, and please provide your introduction.
Thanks a lot, Matt. By way of background, my name's Tim Colbert. I'm a managing director in Deloitte's accounting and reporting advisory services practice. That's a real fancy way of saying that I work in a group that helps our clients answer technical accounting questions from both the implementation and the accounting perspective. My subject matter area is lease accounting. I'm actually, from the ARA perspective, I'm Deloitte's leases leader. I've been following the 842 guidance and the IFRS 16 standard setting as far back as 2010 when the FASB and the IASB issued their first exposure draft. I like to consider myself bilingual because I know both ASC 842 and IFRS 16 better than a vast majority of the world. I'm excited to be here. I always love having these discussions regarding real estate rationalization activities. So with that being said, let me jump to the next slide, and Matt will go over the agenda for today's discussion.
All right. Thank you, Tim. And I do want to encourage everybody to please use your Q&A functionality in the platform. We actually already have one question, and I'll just go ahead and read it now. Please explain the difference between what actions might trigger an abandonment versus an impairment. And so super glad you asked that. We are going to cover those topics today. So that's exactly the type of question that we would like to receive. So to everybody, please go ahead and use that Q&A functionality as you have the have questions pop up. So the agenda today, you can see on the screen here, we're talking about reassessment events, impairments, abandonments, right? You teed up this question perfectly to the person that asked this. Thank you. Impairments, abandonments, lease modifications, and the intersection of ASC 420 into these discussions. And again, these are the exact topics that I get a lot of questions about as people come and say, hey, how do I use CoStar Real Estate Manager to accomplish these types of transactions? Sometimes, I might ask some questions. I know I said I don't give accounting advice to our customers. I leave that to their auditors and accounting advisors. Sometimes I might say something like, are you sure this is an abandonment? Could it possibly be that you're in a lease modification scenario or an impairment scenario? And so, and again, these are the very hot topics. We get these types of discussions and questions all the time, and I know Tim does as well. So, Tim, I'll turn it over to you.
Thanks, Matt. Now, before I move on from this slide, I really want to set the stage of actually why we're here today. As you can very well imagine, a lot of companies are going down the path and taking a good hard look at their current business model to find ways to adapt to the current environment. And two of the more relevant questions that continue to be asked, and it's been this way for the last several years, is where will our employees work, and to what extent will the company's future strategy rely on brick and mortar real estate? And to deal with these questions, some companies have gone down a path of initiating a real estate rationalization program. The end game here is to analyze the overall organization-wide real estate footprint and right-size the real estate portfolio where it makes sense. And what we've been seeing is some companies are outright exiting their lease space before the end of the contract term. And to the participant that asked a question about abandonment, we'll get into that in a little bit. Other companies have actually been expanding their real estate footprint and leasing additional space. And when you think about it, it makes perfect sense. Many organizations are moving to an open floor plan. Many organizations are actually expanding their real estate needs. So to that end, there's a need to actually expand the space. We've also seen others go through the traps of modifying existing lease agreements by eliminating or scaling back certain space while maybe extending the term on other space that they have. So with that as the backdrop, the first area we're going to talk about is lease reassessment events. And I use the term lease reassessment purposely because oftentimes there's confusion between a lease reassessment event and a lease modification. So from the standpoint of a lease reassessment event, what you have to understand is a lot of the changes to a lease do not result in a modification. It results in the enactment of provisions that already exist in the lease. So for example, management may make an internal decision to exit a space early. They may start reducing their workforce. That may result in the need to reevaluate the lease term. However, if management simply changed its intent, meaning that it just made the decision, but there's really no action that goes along with that decision, then that may be just an event that is a management decision that has no impact on the lease itself. So when it comes to reassessment events, the ASC 842 guidance highlights when a lease should be reassessed. And again, a lease reassessment event is based on a provision that's already existing in the lease, as compared to a modification, which is a negotiated change to the contract. So some of the more common lease reassessment events are right here on the slide. There are changes in conclusions about the lease term or conclusions about purchase options. That would require the reassessment of the lease liability and the right of use asset. There could be changes in the amount probable being owed by a lessee under a residual value guarantee, or there could be scenarios where variable payments become fixed and meet the definition of a lease payment due to the resolution of some sort of contingency in the agreement. Drilling down a little further, it's important to understand when it comes to reassessing the lease term, what the triggering events would be in order to allow for the reassessment of lease term. And going around the horn with the 4 boxes in the center, if a lessee installs significant leasehold improvements, or if they customize the asset, that would generally result in a need to reassess the lease term. If hypothetically you are subleasing space and the subtenant exercises its renewal option, that may result in the need to reassess the lease term for the head lease, because the head lease term has to be at least as long as the sublease term. And then the last thing that the standard calls out is when there's a business decision that is directly relevant to the lessee's ability to exercise an option, that would result in a reassessment event. Now, the important thing to highlight here, and this is the white box that's in the left-hand bottom side of the slide, is the change in management intent would not necessarily result in the ability to reassess the lease term. We have seen many companies, just because management or even management with board approval has decided to exit space early or exercise a renewal option in the future, they believe that that constitutes a reassessment event. But it is not until a formal notice is provided to the landlord that the true reassessment would happen. Again, management intent itself would not result in a reassessment of the lease term. When you think of reassessing the lease term, that would happen when something that results in an irreversible decision happens. Now, this next slide provides a handful of examples of what may or may not be considered a reassessment event. So the first example is that the tenant constructs significant leasehold improvements to leased office space, and those leasehold improvements are significant and have a depreciable life longer than the remaining lease term. The tenant's actions of constructing the improvements with the depreciable life longer than the remaining term will directly impact whether or not the lease term should be extended. And that would generally be a reassessment event. The second example on this slide is when the tenant provides irrevocable legal notice to the landlord that it will be early terminating its office space. Because it's a legal the termination and because the tenant has provided legal notice, this notification would be a triggering event to reassess the lease term. And it will impact whether the tenant is now reasonably certain of exercising that termination option or not. So in this case, that would be a reassessment event. The third example in this slide, and this is the one where we've seen a number of questions in practice, is when management or even the executive team approves the early termination of their corporate headquarters. Because management has not undertaken any action with respect to the lease, then, and those actions can't be reversed without significant economic consequences, then that in of itself would not result in the reassessment of the lease term. And that's because management can just as easily turn around and revisit its decision and decide to stay in the space longer. We've seen numerous examples where companies have tried to argue that this represents a business decision, and then they ultimately end up staying in the space longer, which proves out the point that it was just simply management's intent with no binding supportable basis to reassess the term. Now, if the executive team approves the early termination and then they do something else, like they start relocating some of the employees, they start shuttering the doors in certain parts of the building, then that may be supportable. It may be supportable to say that that is a reassessment event. Now, when it comes to reassessment events, the other thing it's important to understand is what happens when you have a reassessment event. And this table is a pretty good table that summarizes what gets updated upon the occurrence of a reassessment event. So if there's a change in the lease term or change in the conclusions around the purchase option, you would generally update everything in the lease. You would update the lease payments. You would revisit the contract consideration, allocate the contract consideration based on the standalone prices. You would update the discount rate and reassess lease classification. In contrast, the other two categories, when there's a change in the amounts probable of being owed under a residual value guarantee, or where there are variable payments that become lease payments due to the resolution of a contingency, while you would update the lease payments, you would update the contract consideration and allocate the consideration to all of the components in the contract, you would not go through the exercise of updating the standalone selling prices, discount rate, or lease classification. So those types of remeasurements are generally a lot easier when it doesn't involve reestablishing the standalone prices, updating the discount rate, and lease classification. So that is, in the context of a remeasurement event, the important things to think about. We're now going to shift to one of the questions that was asked earlier, one of the key topics, and that is, how do you deal with right-of-use asset impairment? Before we even talk about the right-of-use asset impairment, let's just talk about the ASC 360 guidance as a whole. From the US GAAP perspective, yes, sir.
Hey, I just had a thought, and there is one other question that popped in between sections here. But on the lease reassessment discussion, you know, a lot of times this comes across my desk, you know, and squarely in the way you described, reasonably certain, right? So up front, the company has made a reasonably certain assumption that they were to exercise a renewal option or not exercise the renewal option, or exercise a termination option or not exercise. And then that reasonably certain assumption changes. And, you know, they're asking me, well, should we change this in the software or not? You know, it's probably this is probably a topic for a whole nother webinar, but this is one reason why I say accountants aren't going to have to worry about computers taking their job anytime soon, right? Because the descriptions that you provided about when you would, you know, perform the step in a software of checking the box for reasonably certain or not, just involves so much interpretation and thinking through. Well, did the executive committee, real estate committee, for example, make this decision because there's been a significant change in the business or not? Were there significant leasehold improvements made or not? Is it just a change in strategy, or have they already started taking steps? So again, I just thought that highlights my point in the beginning that, while as a software provider, CoStar Real Estate Manager gives companies the tools to flag a option as reasonably certain or not, the decision about when to check that or uncheck that, especially during the middle of a lease, still involves quite a bit of accounting policy and interpretation and applying that policy appropriately. So just a thought I wanted to share about that. And then one question that came in, and I'll direct this to you, Tim. Any chatter, put chatter in quotes, on whether US GAAP will move to a less costly single classification model like IFRS. So what do you think about that, Tim?
There is absolutely no indication that the FASB has any intent or goal to shift from the model that they currently have under ASC 842 to a single model approach. The FASB has spent more than 13 years building out the model, finalizing the model. They heard loud and clear from various stakeholders that not every lease is exactly the same, that some leases are designed to be an alternative financing mechanism, hence you have the finance lease, where the other leases are more operating in nature, and it's basically renting an asset over the lease term. I think that horse has come out of the stable, so to speak, and I do not envision the FASB going down a path of changing the model from a dual model approach that they spend so much time developing to a single model approach.
Cool, thank you. And one other real quick, because it relates to the last topic, what happens if the lease provides an option to early terminate? Is that a reassessment?
If a lease includes an option to early terminate, at the commencement date of the lease, the first cut is to evaluate whether the period covered by the termination option is reasonably certain of not being exercised, to evaluate whether the termination option is reasonably certain of not being exercised. If that is the conclusion at the commencement date, then you do not factor in the termination option into the initial measurement. Now, if something happens that considered a business decision or a reassessment event that impacts whether the termination option is reasonably certain of being exercised, case in point, if they give formal notice that they're going to be exercising the termination option in 1 year, then that would be a reassessment event and require remeasurement of the lease.
Great, thank you.
So, now, moving on to the second topic, and this is right of use asset impairment. And this is an area where companies have had some challenges understanding the guidance. To level set, under US GAAP, long-lived assets should be tested for recoverability whenever there's an indicator that the amount will not be recoverable. The slide here gives you 6 examples. It's right from ASC 360 itself. From the standpoint of once you conclude that there's a triggering event, you have a 2-step impairment model from the ASC 360 perspective. Step number 1 is to test the asset group for recoverability. And the way you would do that is you would look at all of the cash flows related to that lease on an that asset group on an undiscounted basis. If the cash flows are sufficient enough to allow for the recoverability of the assets in the asset group, then you've passed test 1 and you don't move to step 2. Step 2 would only exist when you have not enough cash inflows to support the recoverability of the assets in the asset group. And in that case, what you would do is you would get the fair value of the assets in the asset group, compare it to the carrying amount, and evaluate whether or not you have an impairment from that perspective. So insofar as the long-lived assets carrying amount is greater than the fair value, that would result in there being an impairment. So that's just the base ASC 360 model. And from the standpoint of the applicability of this to the right of use asset, that's where the struggle has been. With that as the backdrop, under ASC 842, you have both finance and operating leases that are now under the ASC 360 model. As I just alluded to in the earlier slides, from the 360 perspective, there is a two-step process to evaluate whether or not there's an impairment of the assets in the asset group. And the two steps we just talked about on the last slide, and this middle box highlights what those two steps are. When it comes to the legacy ASC 420 guidance, after adopting ASC 842, a lessee would no longer recognize an ASC 420 liability related to the lease. In the past, if you had an operating lease, you would always look to the guidance of ASC 420. And insofar as the anticipated sublease income was less than the head lease expense, then you would recognize a loss under ASC 420. But now that the leases are under the 360 model, both operating and finance, ASC 420 is not relevant from the lease perspective. However, ASC 420 may be relevant if there are other contract-related costs associated with the lease and the company did not elect to combine lease and non-lease components. And we'll talk about that briefly as we get to the last topic of the session. So now let's talk about where we are seeing some of the challenges. Right of use asset impairment is evaluated at the asset group level. And I've said this a couple of times already, and it's important to understand, and it's right there in the box on the right, the call-out box. An asset group is the unit of accounting for a long-lived asset or assets that are held and used. And that's the lowest level where there are separately identifiable independent cash flows from other assets and liabilities within the organization. So ASC 360 applied at the asset group level. When there's an actual change in how the leased asset is being used, that may result in a revisitation of the asset group. So if you cease using the asset, if you enter into a sublease of the asset for the asset, each of those items may require the revisitation of the asset group. But until that happens, a commitment to change how the leased asset's going to be used, while that may be an impairment indicator, that would result in no change to the asset group. And the net impact is the evaluation for impairments done at the asset group level. So if you have corporate office space, if you plan on vacating it, you generally will not have an impairment of that space until it's fully vacated and you have a permanent change to the way that asset's going to be used. And that's because of the fact that you're still using that asset as part of the asset group. It doesn't have separately identifiable cash flows. And that's why oftentimes companies make the misstep of impairing a right of use asset, even though there's no permanent change on how it's being used. A couple of other things when it comes to an impairment loss. The impairment loss that's identified as part of the asset group is actually allocated to all of the assets in the asset group based on the relative carrying amount basis. We've seen many organizations take the approach that the first thing they'll do is they'll write off all of the leasehold improvements, and then what they'll do is they'll put the difference against the right of use asset. There are two missteps in that point. Misstep number one is the guidance is explicit that it has to be allocated to all of the assets in the asset group based on the relative carrying amount. The second misstep is you are not permitted per the requirements to reduce or write down any one asset below its fair value. And then when it comes to a right of use asset, right of use assets will always have a value. I'm not aware of any fair value analysis that would say your right of use asset has a zero value so you can write it off. If you were to use the fair value metrics that are included in US GAAP, you would have to take a market participant's view and look at what they would be willing to spend to lease the property based on its highest and best use. And in almost all cases, it would never be zero. So once the asset is impaired, okay, you no longer have a straight line recognition profile. You have a single line recognition profile for operating leases, but not a straight line recognition profile. What the guidance says to do is you will take the right of use asset and derecognize it on a straight line basis over the remainder of the term. You would add the liability accretion to come up with your periodic lease costs. Now, with that as the backdrop, the math results in you no longer having a straight line lease cost. You'll have a single line lease cost that is more front-loaded in nature and very similar to the finance lease model. The areas where I've seen challenges from the operating lease perspective is companies oftentimes, once the asset is impaired, since it's similar to the finance lease model, they start recognizing interest and amortization. But again, you're still in the operating lease model. It's just a single line lease cost that's no longer a straight line lease cost. And from that, and I'll transition this over to Matt. Matt can talk about how CoStar will address impairment.
Yeah, thank you, Tim. So again, similar to the last topic, software is not going to tell you every single step of the way if you should be in the impairment model or not. But once you have made that policy decision or that accounting decision that you have an impairment, CoStar can help you with that, right? One example is on the screen here. I'll talk about another one first. CoStar, for every single one of the properties that you've loaded into your system that you have a lease on, CoStar will give you fair market value type information from our market research of what to put it in Tim's words, what highest and best use or fair market rent might be in your in the area that building is located. So something, again, we won't tell you exactly what the fair market value of the lease is. We will give you cost per square foot and average rents and things like that to help you compute what the value of that lease might be and what you could potentially get from a subtenant, for example. Another thing that software can do for you, as you can see on the screen here, if you decide you're in an impairment scenario for this lease, you can click the impairment remeasurement type in CoStar, and then the amortization pattern changes, just like Tim described for an operating lease here. You can see in the far right-hand side, rent expense was level at $10,000 per period before the impairment. After the impairment, it is not level anymore, and it's and that's exactly per the guidance in ASC 842.
Thanks, Matt. Now, with respect to the finance lease model, the mantra is very much the same. The one difference being the finance lease model does result in interest and amortization expense being recognized each period. It's just that after the impairment, you will have less amortization expense because you would have written off part of the right of use asset due to the impairment. And similar to the operating lease model, CoStar similarly, as Matt will highlight, can address finance lease impairment.
That's right, Tim. And I won't spend much time on this just because it's the same discussion. You click impairment, CoStar will automatically, because it's a finance lease, will apply the proper amortization pattern after the impairment. I will use this opportunity to ask the next question that came in, Tim. Is there a scenario where a company could sublease vacated space at 50% of the headline rent and avoid impairment?
And I will give the typical auditor's answer. You would have to evaluate the facts and circumstances. So when you enter into a sublease, if the sublease is for the remainder of the head lease term, that would generally trigger a reassessment of the asset group to where the right of use asset and any leasehold improvements would then represent a separate asset group because it now has separately identifiable cash flows. And in that respect, you would have to evaluate whether the sublease income, so the cash flows related to the sublease, will allow for the recoverability of the head lease as well as the leasehold improvements. Depending where you are in the life of the lease, you may get to the point where that would be the case. But if it's 50% of the head lease cost, that generally would be a hard hurdle to overcome to get you out of the lease or the impairment model. So you would have to go through the exercise and do the recoverability test to see if there's an impairment. And then the second step is to go through and actually get the fair value of the right of use asset as well as the leasehold improvements for the purpose of determining what the impairment is. Now, there are other scenarios. If the sublease is for 2 years of a remaining 10-year term, you have an additional evaluation to conclude that it is a juncture where you would reassess the asset group. So management would have to conclude that the asset in question will always be an investment property and subleased out. If that is the case, then you may be able to view it as a separate asset group. But if management is unclear as to whether they're going to reoccupy the space after the 2-year sublease, then you may just have a temporarily idled asset, and that would result in impairment being evaluated at a much higher level. So now let's get to my second favorite topic, and this is right of use asset abandonment, where the impairment analysis is done at the asset group level. The abandonment model is applied at the individual lease component level. And that would be the case irrespective of whether you formally split out the lease components or not. For operational efficiency purposes, a company may account for a 10-floor building just as one lease component, but then they may start abandoning floors. At that point, you visit to see if you need to split the building into its various individual components. Now, when it comes to the abandonment model, abandonment would apply when management makes a commitment that it will not use the lease space for any business purposes whatsoever. This includes storage. Abandonment would not apply when management expects to obtain a future benefit from using the property, whether it be redeploying it to a different part of the business, whether it be using this space for storage, or, which is more common, when the company has the intent and ability to sublease the space. Intent and ability is a fairly high hurdle to prove out. So the intent concept is pretty straightforward. If management plans on marketing the property for sublease, then that box is checked. The ability concept is a much different animal altogether, and this involves judgment and may not be straightforward. And this evaluation will depend on several factors. The nature of the leased property, the remaining lease term, the overall demand in the rental market. The call-out box on the right-hand side of the slide is basically the summary of what needs to be considered. it may be reasonable to conclude that the right of use asset has been abandoned if there's a shorter lease term and the rental market is and continues to expect it to be weak for the next several years. On the other hand, it may be more challenging to conclude that the right of use asset has been abandoned if the remaining lease term is longer in length and there's no way to predict the strength of the rental market. We've had many organizations try to argue that the lease term is 5 years, and we believe that we've met the abandonment guidance, and that's really a position that would be hard to support, because that what is effectively being said there is if somebody comes up to you or your real estate department decides to rent out the space, you have already concluded that there's no intent and ability to sublease, and you've already written off the asset. That means that you've abandoned it and really can't sublease it out in the future. To put this all another way, pressure may be put on the conclusion that management has no intent and ability to sublease the space when there's a remaining term that's lengthy. And when you think about it, it wouldn't make sense for a company to keep making lease payments for a property that has many years left without trying to recover its cost. So the bottom line here is abandonment is really meant to be a high hurdle, and management has to be able to support that there's really no intent and ability to derive any economic benefit from using that space in the future. Now, what does it mean and how does the accounting work? Well, once you conclude that the right of use asset will be abandoned sometime in the future, you would accelerate the reduction of the right of use asset to where it will be zero by the cease use date. There's a couple of different approaches that are permitted when it comes to the accelerated reduction of the right of use asset. So I would encourage you to look at your auditor's manuals to figure that out. The liability would not be impacted by the decision to cease using the right of use asset because you still have that obligation. And up until the cease use date, you will recognize a single line lease cost that's made up of the accelerated reduction of the right of use asset and the liability accretion. After the right of use asset has been written down to zero, you still have lease expense. That lease expense is in the form of the liability accretion only. One of the common missteps we see here is after the cease use date, you have companies that now believe that they no longer have lease costs, that they have interest expense. But if you are in the operating lease world, you will still have lease costs, just the liability accretion makes up that lease cost. When it comes to the math behind the model, and this is on the next slide, you'll notice that at the end of the 24-month, or the lease is 24 months with a discount rate of 4%. At the end of month 11, when the carrying amount of the right of use asset is $127,000, the lessee determines that it will vacate the space at the end of period 16. So there's a cease use date. They made the decision that there's no intent and ability to derive an economic benefit. So you'll see that the right of use asset reduction accelerates to where the right of use asset is zero by the end of period 16. You will also see that there's still single line lease costs that continues after the right of use asset is written down to zero. Now, if hypothetically after you've written the right of use asset off, if the company decides to reoccupy the space, or if the company has entered into a sublease, that is where there will be questions about whether the conclusion about abandonment was appropriate. And it may put pressure on your prior financial reporting. So said again, and I'm going to say this again, when it comes to abandonment accounting, in order to achieve abandonment accounting, you have to have no intent and ability to sublease the space, derive any economic benefit whatsoever. Now, the next slide will illustrate how CoStar works in the context of abandonment accounting.
All right, thank you, Tim. And similar to the other topics we've discussed, when this comes across my desk, a lot of times people have a notion of, hey, this is how we want to account for a business case that we're handling right now. And in some cases, it'll be even framed up as, hey, Matt, the real estate department just told me that we're abandoning this space. How do I process an abandonment in CoStar? Now, again, I'm not in the business of giving accounting advice, and I'm not an auditor, but sometimes I will say, well, are you planning to get a subtenant, or do you know if they're going to use it for anything other than offices? Maybe they're going to use it for storage or something like that. If the answer to that is yes, again, I might say something, well, maybe check with your accounting advisors if this is really an abandonment, because words are thrown around, and particularly by non-accountants, right? So when the real estate department comes to the accounting team and says, hey, we're abandoning the office on Main Street, that's perfectly normal use of that word to the real estate team, right? They don't know perhaps that it has a very specific accounting meaning. So my advice there is just ask questions as you get these scenarios, regardless of how it's framed up. If they call it an abandonment up front, ask a few clarifying questions, maybe even look back at Tim's slides and see if maybe there's something that puts you in an impairment scenario or something else, right? Maybe a lease modification. And from the impact on the P&L, I can tell you through lots of examples that I have processed, usually the worst case scenario is an abandonment as far as the amount of expense that gets accelerated onto the P&L, right? In the form of, in this case, accelerated lease expense, that's different than some of the other scenarios where you might have a loss. But either way, it's a debit, to the P&L. An abandonment scenario gives you the biggest debit in most cases, and so I'd say not only are you getting the accounting right, you're probably also by asking questions and making sure you're in the right accounting treatment, you're having a positive impact on the financial statements. But again, if you end up in a abandonment scenario, the screenshot on the far right shows you how CoStar is able to accomplish this, and it ties out exactly to Tim's prepared example.
Thanks, Matt. Moving on to our second to the last topic, and this is lease modifications. And it's important to remember, earlier we talked about a liability remeasurement event, which is the direct result of exercising an existing contract provision. When it comes to a lease modification, this represents a change in the terms of the conditions of the lease due to a negotiated change. So think about change in the scope of the contract or change in the consideration in the contract. This slide demonstrates the various types of modifications that can exist. There could be modifications that are accounted for as a separate contract. That would exist, and this is going up to the top left-hand side of the slide, the top two boxes, insofar as you get an additional right of use not included in the original lease, and it's priced at market, then that would result in the accounting for the lease as a separate contract. However, it's important to remember that those are the only two conditions that can exist and that would be accounted for as a separate contract. Meaning, if you get an additional right of use and it's priced at market. If there are changes to the original lease, then you would never account for that as a separate contract. A perfect example, let's say you are leasing 3 floors of a building and you decide that you're going to add a 4th floor, and you get a separately in contract that says we're going to pay X dollars per square foot for the next 5 years for the 4th floor. As long as it's a separate contract and as long as there was no change to the original contract and the terms are at market, then you would account for the lease of the fourth floor separate and apart from the original lease of the first 3 floors. But now let's say that in connection with the agreement for the fourth floor, you extend the term of the original lease to be coterminous with the lease of the fourth floor, then in that case, you would not be accounting for it as a separate contract. You would be accounting for it on a combined basis with the original lease. And what the guidance would say is, okay, if you're in the world of you're not accounting for it as a separate contract, what do you have to do? And it all depends on whether you're extending the term, whether you're changing the consideration, or whether there's a full or partial termination. If you're extending the term or changing the consideration, you would remeasure the lease based on the now updated lease payments, with the difference going to the right of use asset. If you have a full or partial termination, that would be a scenario where you would remeasure the lease, but the partially terminated space or the fully terminated space would always result in a P&L impact. As it relates to the hot topics in modification accounting, they are listed right here in the slide, and starting from the left going to the right. The first thing when it comes to modifications involving more than one change. Right now in today's real estate world, we're seeing some companies that are reducing the term of one space but extending the term of the other, etc. So the way you would deal with this is you would have to slice and dice the right of use asset into its respective components before applying each of the modifications to each of those components. So that may involve a little work, and it may involve an exercise to figure out how to properly split the right of use asset and lease liability right before the modification. The middle box is discussing the difference between a reduction in the lease term versus a lease termination. When you think about some of the agreements are being inked as the tenant is early terminating the lease. And this is where there's often some confusion. Even though the contract may say the lease is being terminated early, the amendment may not really be a termination for accounting purposes. It may be the reduction of a lease term. The only time termination accounting applies is when the agreement specifies that the property is going to be returned to the landlord immediately upon signing the agreement. If there's a short period of time in which the tenant has to vacate the space, whether it be 60 days, whether it be 3 days, that would effectively result in there being a reduction in the term versus a termination. And you would follow the guidance for reducing the lease term. The last thing I want to highlight on this slide is the accounting for a termination penalty when there's a partial termination. And this is something that I consider somewhat of a sleeper issue, because companies are still having challenges understanding how to deal with termination penalties. When you look at the words in the standard itself, termination penalties meet the definition of lease payments, and lease payments are considered part of the consideration in the contract used to measure the lease. So when the consideration in the contract changes, this meets the definition of a lease modification. And when remeasuring the lease, the revised consideration, which includes a termination penalty, would be allocated to all of the remaining components in the contract. So what the net impact is, the termination penalty will be included in the remeasurement of the remaining lease components and will be included in the remaining lease costs going forward. So much of that termination penalty will be recognized on a go-forward basis prospectively as part of the lease cost for the surviving components. And that's something that many companies are having challenges with, because they equate the termination penalty with the space that's being vacated, but it's nothing other than additional consideration in a contract that gets allocated accordingly. Matt, do you have any observations when it comes to modification accounting, anything of that nature you want to talk about?
Yeah, just super quick. I know we have 5 minutes left, but I'll just add that from a software perspective at CoStar Real Estate Manager, and exactly for the reasons that Tim described, we have at least 3 different ways to quote terminate a lease, and 2 different ways to abstract a termination fee. And so the software can perform an immediate. If you're a CoStar customer, we call it a full termination in CoStar, but as Tim described, that's the scenario where you terminate the lease on the same day, right? It's not 3 months from now, it's not 3 days from now, it's right now, immediate termination. We have that functionality called full termination. Most of the time, people use what I might call regular termination, where it's extended over from the decision date to the actual end date of the lease, the revised end date. And then for the termination fees, we have 2 ways to abstract those as well. One that will be reflected as an immediate expense, the other that gets amortized as lease cost. So just knowing that that's available in the software may be helpful. I'd say the harder part is knowing which which button to push, so to speak. And that's when, of course, I refer you back to Tim's slides or your accounting advisors as you go through those.
Thanks, Matt. Now, real briefly, I want to talk about the application of ASC 420 after the adoption of ASC 842. As a reminder, ASC 420 was generally specific only to operating leases and other executory contracts. And under the old model, you would accrue the cost related to the leases after the cease use date to bring forward the loss related to vacating the premises. Under 842, you're now under the ASC 360 impairment model. So 420 does not apply to operating leases. However, if you did not elect the practical expedient to combine lease and non-lease components, then ASC 420 would apply to other contract-related costs, whether it be insurance, whether it be real estate taxes, whether it be utilities, all of those non-lease components that you're still contractually required to pay, you would have to allocate the consideration in the contract, and you would have to estimate and recognize a 420 liability for those costs. Now, if you've elected the expedient to combine lease and non-lease components, which from the real estate perspective, a number of organizations, I would say a vast majority of the organizations have, that means that the entire contract is outside of ASC 420 and would fall under the 360 model. Some of the missteps we've seen here is, even though companies have elected the expedient to not separate lease and non-lease components, they still accrue other contract-related costs under the lease, which, because they've elected the expedient, that would not be appropriate. This particular slide summarizes at a high level what costs are subject to ASC 420, which costs are not subject to ASC 420. So the portion of the fixed payment in the contract allocable to the non-lease components would be subject to 420. And similarly, the portion of the estimated variable payments in the contract allocated to the non-lease components would similarly be subject to 420. The amounts not subject to 420 would be the portion of the fixed payments allocable to the lease component, portion of the estimated variable payments allocable to the lease components, or all fixed and variable payments in the contract when the lessee has elected to not separate lease and non-lease components. I think this is all we have, all the time we have for today. Matt, do you have any closing remarks?
No, except just to say, Tim, thank you as always for sharing your knowledge, and I appreciate it. The slides are available. If you have any questions at all, feel free to reach out. You can find me on LinkedIn. You can find Tim there as well, and we're always happy to talk about lease accounting. So thank you everybody for joining us, and have a great day. Boyana, back to you.
This marks the end of our webinar. Thank you so much for joining us today. We look forward to you joining us on future webinars. You can find information about upcoming webinars in the resources window. Don't forget to download your CPE certificate in the certification window. Your CPE certificate will also be available to download in the thank you for attending email that will be sent within the next 24 hours. If you have any questions regarding CPE credits, please feel free to email events@financialexecutives.org. Have a wonderful day, and again, thank you to our speakers for today's webinar.
Have a great day all.
Thank you.